All right, let's start with a few of our top observations from the first half of the year. First, balanced investors have enjoyed one of their best starts to the year in recent memory. The Vanguard Balance Fund, which is the green line here, is a pretty typical 60/40 portfolio of US stocks and bonds. And that green line shows that in the first 6 months of the year, that fund was up 10.5%, which is the second best start to the year since at least 2001. It's stark contrast to that brown line, which is 2022, in which investors lost 17% in the same fund. So a much better start to the year for diversified investors. Second observation, the dispersion between growth and value stocks continues. Last year was all about the return to strength for value and energy stocks in particular. This year, it's been all about growth and cyclical sectors, things like technology, consumer discretionary, and communication services that have really been leading the way. And third, cash is king. Money market funds, CDs, even savings accounts. Investors have been flooding back to these vehicles to take advantage of higher interest rates, many of which are paying 5% or more. Market Watch even reported recently that high net worth investors are keeping about a third of their net worth in cash and cash alternatives. So big, big numbers. So there were a couple of trends or themes that really influenced stock prices or markets in general in the second quarter. The first of which is artificial intelligence or AI. It seems like everywhere you look, you can't help hearing more and more about artificial intelligence and programs like ChatGPT as folks become more familiar with how to use these tools and ultimately improve productivity. At least that's the hope. It's also showing up in stock prices. NVIDIA, which provides chips that power a lot of these AI programs, reported earnings in May, and investors were so excited by their outlook that their market cap grew by $184 billion in a single day. So let's put that in perspective. How big is $180 billion? Well, that's larger than companies like Wells Fargo, Boeing, Caterpillar, Disney, and Lowe's, just to name a few. So huge, huge numbers. And of course, we're still paying very close attention to inflation and interest rates. In May, it seemed like a lot of the market watchers expected the Fed to be finished with their rate hiking cycle. And now they've essentially said not so fast, leaving the door open for another hike or two in the back half of this year to make sure that inflation remains under control. A lot of economists are still expecting the US to slip into a recession in the back half of 2023 or 2024. If that's the case, how, as investors, should we think about that? First thing we'll say is that everybody's situation is different, but here are a couple of general ideas that might be worth consideration. First, revisit some of the risks in your portfolio. We mentioned that 2023 has been a great start to the year for diversified investors, but a lot of those returns have been concentrated in a few pockets, in a few areas. Make sure that hasn't introduced any unintended risks in your portfolio, and it could be an opportune time to rebalance into some of the areas that may have been underperforming. Secondarily, revisit the concept that cash is king. Yes, cash rates today are much more attractive than they have been in recent memory, but if history's taught us anything, it's that cash has been a very poor way to achieve long-term investing goals. Historically, inflation erodes the value of cash. And so if that money is intended to fund long-term goals, consider putting a plan in place to get those dollars reinvested in other areas, other vehicles that can actually grow your purchasing power over time.